mega cap tech and gave other stocks a chance to perform. It happened, pretty painlessly for a little while. Now it feels like it's a bit messier. How are you thinking about this idea of a broadening market and whether, it's still one that can hold up in general?
Thanks, Mike. Great to be here. Yes, it is a bit messier. Be careful what you wish for, I guess. We do have a lot of uncertainty right now. There's high political uncertainty, high economic uncertainty, and also I would call it an air of skepticism in terms of what AI can deliver in terms of profitability and productivity, at least in the near term. And the market right now is very much in a prove it to me state or a show me state and wants to see this happen or see proof on a more accelerated time frame. So I think right now we have to stick with themes that are working and that continue to work over the medium term where the money's going. We think there are areas that continue to be stable and hold up well, such as U.S. infrastructure should do well. We think areas where spending is healthy in terms of some of the trends for things such as cruise lines. There's a lot of money in the space that's still continuing to flow into there. So we think they're healthy areas of the market, but right now the mega caps, which have done so well and led the market, are going to struggle for a while until they can gain their footing and have more of that proof come forward.
On the one hand, you can tell the market is getting just a little bit uncertain about whether there's staying power in the economy, and the consumer can hang in there. You get some stories about credit losses and lower spending in certain areas. On the other hand, you have banks leading the way this month to the upside. You like cruise lines. It would seem as if, that would suggest that the economy is still plugging along okay, and maybe the market is just having a little bit of a hiccup.
Well, we are going to see mixed economic data. We are expecting that. We think it would be a mistake, however, to interpret mixed economic data as a downturn that's gathering momentum to the downside. We think that the underlying fundamentals are healthy. We think that the labor market is relatively healthy and can use some support from the Fed. And we think that support is just around the corner. But overall, we think that earnings growth, economic growth, and what will eventually be benefits from trends such as AI will start to kick in the coming quarters. So we do think it'd be a mistake to read too much into some of the soft data numbers that might come out in the coming months.
That being said, you don't think it's out of the question that the Fed might cut by a 0.5 percentage point in September? That's a little more maybe than the market has priced in. Why do you think that might be the appropriate at that point?
Yeah, we've been talking about that for a couple of weeks now, about this possibility. We don't think it's the most likely scenario, but we don't think it would take that much right now. Given how much inflation has come down and even all the forward-looking indicators for inflation to continue coming down, we think the Fed has a lot of latitude to cut rates. And the one rate cut right now that the market is pricing in is really based on what the Fed had been messaging as a balanced labor market. But if you look under the hood, we're seeing signs that the labor market could actually use a little bit of support here. Weekly initial unemployment claims are starting to climb. Even if we look at June's labor report or jobs report, under the hood, you see that prior month's revisions were pretty large to the downside. You see that almost all the job growth came from the government sector and the healthcare sector. So it does look like a labor market that could use support, and it would only take a few more data points. It would probably shift the Fed's thinking to cut rates potentially by 50 basis points in September, and we think the market is underpricing that potential right here.
So if the bond market is underpricing that potential and it happens, what is the likely or proper response from the stock market? Should it say, oh, things are worse than we thought, or this is going to be a needed easing of policy that we can capitalize on?
Most likely the latter, although there could be a knee-jerk reaction in the market, or the market thinking the economy could be weaker. The Fed's perhaps seeing things that the market isn't seeing. But we think the underlying fundamentals are healthy, and that the Fed is about to start on a campaign of cutting rates for the next year. And we think that's going to provide a nice tailwind. So if we take a step back and look at the big picture, where we have earnings growth, we have a Fed that's about to begin on a year-long rate cutting campaign, along with underlying fundamentals that remain relatively healthy, we think we're in a decent place here. And right now, the market is just at a crossroads where it's expecting more proof than can really be delivered by companies in the short term about some of these benefits to the AI and other technology trends.